Let me ask you something. Have you ever noticed how the rules of money seem to change every few years, yet most people keep playing by the old rules? They save diligently in a savings account that pays almost nothing. They follow the advice their parents gave them about working hard and putting money aside. And then one day, they wake up and realize the game has completely changed. Their savings have lost value. Their job security isn't what it used to be. And the people around them who seem to understand something different are now miles ahead. This isn't about luck. It's about understanding the invisible forces that shape our financial lives. And right now, in 2026, we're standing at one of the most critical turning points in modern economic history. What worked for the last 40 years is being rewritten. The old financial system, the one built on endless credit expansion and falling interest rates, is reaching its limits. And if you don't understand what's happening, you're going to get left behind. Think about this for a moment. Since the 1980s, we've lived in a world where borrowing money became cheaper and cheaper. Central banks kept lowering interest rates. Governments kept printing more money. Asset prices, whether stocks or real estate, kept going up. If you bought a house in 1990, you probably did very well. If you invested in the stock market over the last few decades, you likely made significant returns. But here's the thing, that entire system was built on a foundation of falling rates and expanding debt. And now that foundation is cracking. Ray Dalio has spent his entire life studying economic cycles, understanding how empires rise and fall, how currencies lose their power, and how wealth transfers from one generation to the next. And what he's seeing now is a pattern he's studied throughout history. It's the end of a long-term debt cycle. Picture it like this. Imagine you have a credit card with no limit. For years, you keep spending more than you earn because the interest rate is so low it feels almost free. You buy a bigger house, a nicer car, you take vacations you couldn't otherwise afford. Life feels good. But eventually, the bill comes due. The interest rate goes up. Your debt becomes unbearable. You can't borrow anymore. You have to cut back dramatically. That's where we are right now. But on a national and global scale, countries around the world have accumulated debt like never before. The United States alone has a national debt exceeding $34 trillion. That's not just a number on a screen. That's a burden that will shape tax policy, government spending, and economic growth for decades. When debt gets this high, governments have limited options. They can try to grow their way out, which requires exceptional economic growth that's difficult to achieve. They can raise taxes, which is politically unpopular and can slow down the economy. Or they can print more money, which devalues the currency and erodes your purchasing power. None of these options are painless. So what does this mean for you? It means the old playbook doesn't work anymore. Saving money in a traditional bank account is essentially watching your wealth slowly disappear due to inflation. Relying on a single income source in an unstable job market is risky. Ignoring how money actually works in this new paradigm is financial suicide. You need to think differently. You need to understand that wealth isn't built by following the crowd. It's built by understanding the fundamental principles that govern economic cycles and positioning yourself accordingly. Let me give you a simple but powerful example. Imagine two people in the year 2000. Both have $10,000 to invest. One person puts it in a savings account earning minimal interest. The other person studies the economic environment, understands that inflation is coming, and diversifies into assets that hold value during inflationary periods: real estate, commodities, certain stocks, and even alternative stores of value. Fast forward to today. The person who kept their money in savings has barely kept pace with inflation, if at all. The person who understood the game has multiplied their wealth several times over. The difference wasn't luck, it was understanding. Right now, we are in a moment where those who understand what's happening will build generational wealth, and those who don't will struggle more than ever before. The question is, which side of that divide will you be on? 7:30 p.m. The truth is, most people never learn how money really works because nobody teaches them. Schools don't teach it. Parents often don't understand it themselves. And the financial industry, they profit from your ignorance. They want you to keep your money in products that benefit them, not you. But once you understand the real game, everything changes. So let's talk about what's actually happening right now. For the first time in decades, we're seeing something that an entire generation hasn't experienced: the end of easy money. Interest rates have risen dramatically. Central banks, which spent years flooding the economy with cheap cash, are now trying to pull that money back out. Why? Because inflation got out of control. When you print trillions of dollars and pump them into an economy, prices inevitably rise. Your groceries cost more, your rent goes up, everything becomes more expensive. And suddenly, the money you thought was safe is worth less and less. But here's where it gets interesting. This isn't just an American problem. This is happening globally. China, once the engine of global growth, is facing its own debt crisis. Europe is struggling with energy costs and economic stagnation. Emerging markets are dealing with currency devaluations. We're watching a synchronized global slowdown that hasn't been seen since the 2008 financial crisis, and in some ways, this could be worse because the tools that governments used back then, lowering rates and printing money, have already been exhausted. Ray Dalio talks about something he calls the changing world order. Throughout history, there have been dominant powers that control the global financial system. The British Empire had the pound sterling. Now, the United States has the dollar. But these empires don't last forever. They rise, they peak, and eventually they decline. And part of that decline always involves the devaluation of their currency. Think about it. Every major empire in history has eventually debased its currency to pay its debts. Rome did it by mixing cheaper metals into their coins. Modern governments do it by printing money. The method changes, but the outcome is the same: your money loses value. Now, I'm not saying the dollar is going to collapse tomorrow. But what I am saying is that we're in a transition period. The world is slowly moving away from a system where one country's currency dominates everything. We're seeing countries like China and Russia making deals in their own currencies, bypassing the dollar entirely. We're seeing central banks around the world buying gold at rates we haven't seen in decades. Why? Because they're hedging against the very system they're part of. They understand something that most regular people don't. The rules are changing. So what should you do? First, you need to change how you think about money. Stop thinking of cash as the safest option. In a world of inflation and currency debasement, holding too much cash is actually risky. Your purchasing power erodes every single day. Instead, think about assets that preserve value over time. Real estate, when bought correctly, can protect you against inflation because rents and property values tend to rise with inflation. Commodities like gold and silver have been stores of value for thousands of years, long before any modern currency existed. Quality businesses that produce essential goods and services will continue to generate value regardless of what happens to paper money. But here's the key: diversification isn't just about having different stocks in your portfolio. It's about having different types of assets in different currencies and different countries. It's about not having all your eggs in one basket when that basket is sitting in a system that's fundamentally changing. Ray Dalio himself has famously said that if you don't own gold, you don't understand economic history. That's not because gold is some magical investment. It's because throughout every major financial crisis, every currency collapse, every period of extreme uncertainty, gold has maintained its value. It's the ultimate insurance policy. Let me tell you a story that illustrates this perfectly. In the 1970s, the United States faced a similar crisis. Inflation was out of control, the dollar was losing value, people were panicking. Those who kept all their money in cash or bonds got destroyed, their wealth evaporated. But those who owned real assets, gold, real estate, commodities, not only survived but thrived. By the end of that decade, there was a massive transfer of wealth from those who didn't understand what was happening to those who did. We're about to see another transfer like that. The only question is, will you be on the winning side or the losing side? Here's another critical principle. Debt is a double-edged sword. In a world of falling interest rates, debt can be your friend. You borrow cheap money, invest it in assets that appreciate, and you come out ahead. But in a world of rising rates, debt becomes a burden. Your interest payments go up. Your flexibility disappears. You become trapped. Right now, millions of people are over-leveraged. They bought houses they can barely afford with adjustable rate mortgages. They financed lifestyles on credit cards with high interest rates. And as rates have risen, they're drowning. Don't be one of them. 11:31 p.m. Instead, use this moment to get your financial house in order. Pay down high interest debt aggressively. Build an emergency fund that can cover at least 6 months of expenses, not in risky investments, but in accessible cash or cash equivalents. Create breathing room in your life so that when opportunities arise, and they will arise, you have the resources to take advantage of them. Because here's what always happens during these transitional periods: assets get mispriced, fear takes over, people sell things they shouldn't sell at prices they shouldn't accept, and those who have capital and courage step in and buy generational wealth at discount prices. Think back to 2008. When the housing market collapsed, people were terrified. They thought real estate would never recover. But those who understood the cycle, who had cash ready, who weren't over-leveraged, bought properties at 50 cents on the dollar. Those properties are now worth 2, 3, sometimes 4 times what they paid. That wasn't luck. That was preparation meeting opportunity. The same thing happened in the stock market. In March 2009, you could buy shares of some of the best companies in the world at prices that seem absurd today. Amazon was trading under $70 a share. Apple was in the teens. Those who had the knowledge and the resources to act became wealthy. Those who panicked and sold everything lost fortunes. We're approaching another one of those moments. Maybe not tomorrow, maybe not next month, but it's coming. The combination of high debt, geopolitical tensions, currency instability, and changing economic structures creates an environment where something has to break. And when it does, there will be chaos. Markets will crash. People will panic. The media will scream about the end of the world. But for those who understand the game, who have prepared properly, who see through the noise, it will be the opportunity of a lifetime. Now, let me be clear about something. I'm not telling you this to scare you. Fear without action is useless. I'm telling you this to wake you up, to inspire you to take control of your financial future. Because the biggest mistake you can make right now is to do nothing, to hope that somehow everything will work out, to trust that the system will protect you. The system isn't designed to protect you. It's designed to protect itself, and in the process, it will sacrifice your wealth, your savings, your retirement if necessary. Ray Dalio has a principle he lives by. He who lives by the crystal ball will eat shattered glass, Nobody can predict exactly when or how things will unfold, but you don't need perfect prediction. You need sound principles. You need to understand the forces at play. You need to position yourself so that no matter what happens, you're protected, and ideally, you're positioned to benefit. Let me give you 3 actionable steps you can take right now, today, to start positioning yourself correctly. First, educate yourself. Stop relying on headlines and sound bites. Read books about economic history. Study previous financial crises. Understand how the wealthy protected and grew their fortunes during turbulent times. Knowledge is your greatest asset, and unlike money, once you have it, nobody can take it away. Read Principles by Ray Dalio. Study The Creature from Jekyll Island to understand how central banking really works. Learn about Austrian economics and why sound money matters. Second, audit your current financial position with brutal honesty. Write down every asset you own and every debt you owe. Calculate your net worth. Look at where your money is positioned. Are you too concentrated in one area? Do you have too much debt? Are you completely dependent on a single income source? Are all your assets denominated in one currency? Most people avoid this exercise because they're afraid of what they'll find. But you can't fix what you won't face. Get clear on where you actually stand. Third, start building your ark before the flood comes. You don't wait until the hurricane is overhead to board up your windows. You prepare in advance. Begin allocating resources into assets that protect against currency debasement and economic instability. This doesn't mean selling everything and buying gold coins to bury in your backyard. It means intelligent diversification. Maybe it's 5 or 10% of your portfolio in precious metals. Maybe it's investing in your own skills and education so you're more valuable in any economy. Maybe it's starting a side business that generates additional income streams. Maybe it's buying that investment property you've been considering. The specific actions will vary based on your situation, but the principle remains the same: prepare now while you still can. Here's something else Ray Dalio emphasizes constantly: the importance of understanding how the economic machine works. Most people think the economy is this mysterious, complex thing that only experts understand. But at its core, it's simple. The economy is just the sum of all transactions. You buy something, that's a transaction. Someone lends money, that's a transaction. Multiply that by billions of people, and you have the economy. And all of these transactions are driven by credit. When credit expands, the economy grows. When credit contracts, the economy shrinks. Right now, we're moving from a 40-year period of credit expansion to a period of credit contraction. That's the shift. That's what changes everything. When credit contracts, asset prices fall. Companies that relied on cheap borrowing struggle or fail. Jobs are lost. Economic growth slows or reverses. This isn't pessimism, it's pattern recognition. It's happened before, and it will happen again. But here's the beautiful part: if you understand the pattern, you can position yourself not just to survive, but to thrive. You can be the person who buys assets when everyone else is selling in panic. You can be the person who provides value and solutions when others are paralyzed by fear. You can be the person who emerges from the crisis significantly wealthier than you entered it. Let's talk about something that makes most people uncomfortable: the idea that your government might not be able to protect you. We've been conditioned to believe that if things get really bad, the government will step in and fix everything. They'll bail out the banks. They'll send stimulus checks. They'll lower interest rates. And yes, they'll try all of those things. But what happens when those tools stop working? What happens when printing more money just makes inflation worse? What happens when lowering rates can't stimulate growth because everyone is already drowning in debt. What happens when the government itself is so indebted that its promises become questionable? This is where personal responsibility becomes critical. You cannot outsource your financial security to institutions that are themselves unstable. Social security might not be there in the form you expect. Pensions are underfunded across the board. The safety nets that previous generations relied on are fraying. This isn't a political statement, it's a mathematical reality. The promises that have been made exceed the resources available to fulfill them. Something has to give, but let me share something empowering with you. Once you accept this reality, once you stop expecting others to save you, you become powerful. You take control, you stop being a victim of circumstances, and start being an architect of your own future. And that mindset shift is worth more than any investment advice I could give you. Ray Dalio talks about radical transparency and radical truth. Let's apply that here. The radical truth is that most people are not prepared for what's coming. They're living paycheck to paycheck. They have no emergency fund. They don't understand how money works. They're completely dependent on a system that's becoming increasingly unstable. That's the harsh reality. But the opportunity within that reality is enormous. Because while the masses are unprepared, you don't have to be. While others are ignoring the warning signs, you can be paying attention. While they're making emotional decisions based on fear and hope, you can be making rational decisions based on principles and understanding. Think about the concept of anti-fragility. This is an idea from Nassim Taleb, another brilliant thinker in this space. Anti-fragility means you don't just survive shocks to the system, you actually benefit from them. How do you become antifragile? By having optionality, by being diversified, by not being over-leveraged, by having skills that are valuable in any environment, by having multiple income streams, by owning assets that perform well during different economic conditions. When you structure your financial life this way, uncertainty becomes your friend, not your enemy. Let me give you a concrete example of antifragility in action. Imagine you have all your money in tech stocks, a single job in the tech industry, and a mortgage on a house in a tech hub like San Francisco. You are incredibly fragile. If the tech sector crashes, you lose your job, your investments plummet, and your house value drops simultaneously. You're wiped out. Now imagine a different scenario. You have multiple income streams, a primary job, a side business, and investment income. Your investments are spread across different asset classes, stocks, bonds, real estate, commodities, and some alternative investments. You have skills that are transferable across industries. You live below your means with minimal debt. When a crisis hits, yes, some of your assets might decline, but others might actually increase in value. You have options. You have flexibility. You're antifragile. This is the level of thinking you need to adopt. Not just, how do I make money? But how do I structure my entire financial life so that I'm protected against multiple scenarios and positioned to benefit from change? This is how the truly wealthy think. They don't gamble on one outcome. They prepare for multiple outcomes and position themselves to win regardless of which one occurs. Now, let's address something important, the psychological side of this journey. Knowing what to do and actually doing it are two completely different things. The human brain is wired for short-term thinking. We're programmed to seek immediate gratification and avoid immediate pain. That's why most people can't follow through on financial plans. Saving money requires delaying gratification. Building wealth requires patience and discipline. Making smart decisions during a crisis requires controlling your emotions when everyone around you is panicking. 11:34 p.m. This is why Ray Dalio emphasizes the importance of principles. Principles are rules you establish when you're thinking clearly so that when emotions run high, you have something to anchor yourself to. When the market crashes and everyone is selling in panic, your principle might be, I buy quality assets when they're undervalued, regardless of how scary the headlines are. When inflation is eroding your savings and you're tempted to chase risky investments promising quick returns, your principle might be, I only invest in things I understand, and I never risk money I can't afford to lose. Create your own set of financial principles now while you're calm and rational. Write them down, make them specific. And then, when the storm comes, and it will come, you'll have a compass to guide you through the chaos. Without principles, you'll be blown around by every news headline, every market move, every fearful thought. With principles, you become steady, focused, and effective. Let's talk about something else that separates the wealthy from everyone else, their relationship with risk. Most people think the wealthy are big risk takers, gamblers who bet it all and get lucky. That's completely wrong. The truly wealthy are actually extremely risk averse, but they understand risk differently than most people. They see the biggest risk as not being prepared, not being educated, not being diversified. They see safety in knowledge and flexibility, not in hiding money under a mattress or keeping everything in a savings account. Warren Buffett, another investing legend, has a famous quote, risk comes from not knowing what you're doing. That's the key insight. When you don't understand how something works, everything feels risky. When you deeply understand it, you can see where the real risks are and where the opportunities lie. This is why education is so critical. Every hour you spend learning about economics, finance, investing, and business is an hour spent reducing your risk and increasing your potential for wealth. Here's a practical framework you can use right now. Divide your financial life into 3 buckets: safety, growth, and speculation. Your safety bucket is money you cannot afford to lose. This is your emergency fund, money for near-term expenses, funds you'll need in the next few years. This money should be in stable, liquid assets. Yes, it might lose purchasing power to inflation, but its primary purpose isn't growth, it's protection and accessibility. This bucket gives you peace of mind and options. Your growth bucket is money you're investing for the long term. This is where the bulk of your wealth building happens. This is money in quality businesses, real estate, assets that generate income and appreciate over time. This bucket requires patience and discipline. You're not trying to get rich overnight. You're building wealth systematically over years and decades. This is where you apply the principles of diversification, buying quality assets at reasonable prices, and letting time and compound growth do their work. Your speculation bucket is money you can afford to lose completely. This is where you take calculated risks on higher reward opportunities. Maybe it's a startup investment, a cryptocurrency, a concentrated bet on a sector you believe will boom. This bucket should be a small percentage of your overall wealth, maybe 5 to 15% at most. If you lose it all, it stings but doesn't destroy you. If one of these bets pays off, it can significantly accelerate your wealth building. But never, ever confuse speculation with your core wealth building strategy. Most people get this completely backwards. They keep too much in the safety bucket, earning nothing, getting eroded by inflation. They have almost nothing in the growth bucket because they're afraid or they don't know where to start. And then they take their limited resources and gamble them in the speculation bucket, chasing get rich quick schemes because they're desperate to catch up. This is a recipe for financial disaster. Restructure your thinking and your allocations according to these 3 buckets, and you'll be ahead of 90% of people. Now, Let's bring this back to the bigger picture of what's happening in 2026 and beyond. We're living through a monetary regime change. The old system, built on the dollar's dominance, cheap debt, and globalization, is being replaced by something new. We don't know exactly what that new system will look like yet. Maybe it involves digital currencies issued by central banks. Maybe it involves a multipolar world where several currencies share influence. Maybe it involves a return to commodity-backed money in some form. The specifics are unclear, but the direction is certain change is coming. During regime changes, wealth is redistributed. Those who cling to the old system lose. Those who adapt to the new reality win. Think about what happened when the world moved from the gold standard to fiat currency in 1971. People who held only gold initially felt vindicated, but those who understood the new paradigm and invested in assets that thrived in a fiat system, real estate, stocks, businesses, built enormous wealth. The same thing is happening now, just in reverse. We're moving away from the pure fiat system towards something else, and those who understand this transition will position themselves accordingly.